In the entire history of the FAANG Stock Recap Show, I don't think we've ever had a show that is as big as this one. That is because we heard from multiple companies this week from an earnings perspective. We first heard from Meta, and we saw its shares decline by over 13.5%. Do you buy the dip on Meta? What is causing the decline, and where are the technical areas where the buyers are likely to step in? We'll answer those questions on today's show. If you've been trying to buy one of the new iPhones, like I have, you're waiting several weeks. So it should come as no surprise that Apple reported the upcoming quarter is likely going to accelerate to double-digit growth. We'll talk about what that means for Apple going forward, both on the iPhone side, but more importantly, the more profitable service side of the business. We had earnings from Amazon, and we saw Amazon shares skyrocket. And here's the thing that I'm going to teach you on today's video. Everything that Amazon said on their conference call and everything that saw its shares rise by about 10% today alone was all telegraphed over the past 365 days. I'm going to show you the exact post that I look at that led me to recommend Amazon to our paid subscribers back in September. This was all telegraphed. It's all something that you could find out yourself if you spend the time and do the research. I'll show you exactly how to do that on today's show. We had a 10-for-1 stock split in Netflix. We also heard earnings from Microsoft and even Google as well. We've got so much to get to. In fact, I am doing something that I almost rarely do. I am turning off the ads. This video will not be monetized because it is so important, and I want you all to be interruption free as we kick things off like we always do with Meta Platforms. Start of the week at 750, down 13.5%. Mark Zuckerberg's not having a good day in Menlo Park as shares of Meta finish the week at about $650 per share. This comes as the company announced those Q3 earnings. I'm sure you guys saw this. Revenue was fantastic. $51 billion, 26% growth, but they missed on the EPS side. A stubborn tax provision to the tune of $19 billion blew up their EPS, but I think that's only a part of the story for Meta. That is because they shed over $200 billion in market cap this week, and there's scar tissue with Meta when it comes to the VR Reality Labs unit that has shed $73 billion of cumulative losses since they began that a couple of years ago. Now, yes, this is a $1.6 trillion valuation company, but $73 billion is a lot. And that's on the VR unit. Now we are going down the path where Mark is going to ramp up his spending. And in the past, he's maybe overdone it, and it hasn't necessarily led to incremental revenue in those business units. I'll discuss here in a minute whether I think Mark is making a mistake. Like I said, he was the first time around. Now, the company is going to finance a lot of this with debt, and they are going to raise a record $30 billion in bonds ranging from anywhere from 5 to 40 years in maturity. It'll show up in the company's financials in the future time. Now, speaking of those financials, look, the core business is absolutely fantastic, as you would imagine. Yes, cost ballooned from $23 billion up to $30 billion over the past year, but you still have very solid $20 billion of income from operations. And if it wasn't for that provisions for income taxes, well, it would have been a solid enough quarter. Here's where things are going to get a little tricky on Wall Street is they are going to look at the balance sheet and they are going to see back in December, the company had $77 billion in straight cash homing. Now they have just $44 billion. Now it is being transferred down into property, plant, and equipment, 121 all the way up to 160, but you are going to lever that up eventually down here on the debt side, and that will show up in future quarters. Now, also what investors are going to be taking a look at, because when we look at Microsoft a little bit later, and certainly Google as well, what you're looking for on the statement of cash flows that the company gives you every single quarter is you want to come down for the 3-month ended. You want to come down here and look at their operating statement. $30 billion of operating cash flow, $25 billion last year. As you know, all of these companies are ratcheting up their spending in the capital expenditure aisle for those Nvidia GPUs and the data center. And they all committed to spending even more going forward, Purchases of property, plant, and equipment for Meta in the quarter, nearly $19 billion. So there's a $10 billion spread here. It's still positive free cash flow, but then you're going to come down and pay a little bit of a dividend and buy back the shares as well. There's absolutely nothing wrong with that, but the spread of the operating cash flow minus the property, plant, and equipment, otherwise known as free cash flow, it's smaller on Meta than when we look at Google and then when we look at Microsoft. Now, it's not as small as when we look for Amazon, and this is one of the first instances where the market has punished a company for aggressively spending. We'll see if the market continues to do that or if things will turn around. Now, Mark Zuckerberg on the conference call said some interesting things, and this is the key thing to focus on as an investor. There's going to be a lot of noise around Meta. In fact, a lot of the noise is going to run in parallel of the noise that we heard with Google earlier in this year. Early this year, as you imagine, and remember, Google shares were in the dumps, and that is because people worried about ChatGPT cutting into iPhone searches and all those types of things. Well, here we sit, and we'll talk about Google here in a minute. Shares are essentially at all-time highs. The same doubts are going to be whispered and talked about within the financial community about Meta. But here's the important thing to remember, exactly what Mark Zuckerberg here. Unlike the metaverse, which was cooked up in Mark's brain and conjured up before there was any demand for it, that is different about AI. He says, to date, we keep seeing this pattern where we build some amount of infrastructure. He talks about data centers here to what we think is an aggressive assumption. And then we keep on having more demand to be able to use more compute, especially in the core business. So he's saying that inside of Meta, they have these aggressive assumptions. And I believe it. You do see it show up here on the financials. They have some aggressive assumptions and they're spending money to shore up that demand. But then more and more demand comes online, particularly in the core business. And the core business over at Meta is doing absolutely phenomenal. Now, the other very interesting thing he said on the conference call, didn't see anybody talk about this. He says almost every week, people come to us from outside of the company asking us to stand up an API service, essentially maybe some type of API service similar to what you have over at Anthropic, OpenAI, and certainly Grok as well, where you can tap into the model, where you can tap into their data center. Meta saying that they have companies coming to them asking them if we have different compute that they could get from us. And we haven't done that yet. But obviously, if you got to a point where you ever overbuilt, you could have that as an option. I tell you what, if Meta announced the Meta Cloud, the stock would rise by 10 points in a single day. And so this is always in Mark's back pocket. He did float the idea out here. I didn't see anybody talk about it, but if they overbuild, they can always monetize this at a later date over at Meta. I believe that the conversations people are having about Meta are going to be looked back upon very similar to the conversations we were having about Google 6 months ago. People were worried about Google search, worried about monetization. The same thing is going to be true about Meta. 6 months, 12 months forward, we're going to be looking back and saying, wow, AI is doing great things for their ad business, doing great things for the billion of users that they have on their platform every single day. Those billion users are having a better experience and the product is better. And that means more ads are getting clicked on and Meta is making more money. I think this investment is worth it. And many of you that have been following me for a while, remember, I was highly critical of Mark's investment in the metaverse. And it turns out that was actually a pretty good criticism. This VR unit has done jack crap for the company from a financial perspective. I believe the investment that they're making in AI is similar to what Google was making, and the payoff will be similar to Google. It will take time, but Meta will bounce back. Moving on to Apple. Start of the week at 265. This one, I mean, nobody can get their hands on the new iPhones, and that had shares of Apple climb by 2%. This week alone. This comes as the company announced their Q4 earnings revenue of $102.2 $6.5 billion. That was 8% growth for this company that people were saying missed AI and Siri sucks and all this type of stuff. None of that matters. Nobody buys an iPhone for Siri. Nobody's buying an iPhone for Apple Intelligence or any type of AI. You can download the ChatGPT app. You can download Grok, and you're going to use your iPhone to tap into a lot of this AI stuff. Now, there was some interesting things said on the conference call and some interesting things Tim Cook telegraphed for the future. I'm going to save that for the premium subscribers because I think that is going completely under the radar, but we will focus on the fact that they've got double-digit growth planned for the fiscal first quarter, otherwise known as the calendar fourth quarter. 10% growth or more in the upcoming quarter due to the stronger than expected iPhone sales. That will likely lead to a couple of things for Apple, and some of you might be wondering, well, Apple's shares are essentially at like 52-week highs, all-time highs. Can they push higher? The two things that can push them higher is, first of all, we understand that the iPhone sales will reach some type of capacity or peak, likely this quarter or next quarter, and then they'll start to tail off a little bit. But as we know, the iPhone sales spur a lot of service revenue, and that is obviously dramatically high gross margins that flows almost all the way down to operating profits and net income for the company. So stronger unit sales will lead to stronger high profit margins service sales. Now, the other wild card is China. You see in the most recent quarter, that was the one region that did not bounce back. 15 billion down to 14.5 across the board. All other regions absolutely on fire for Apple. When I'm listening to the company's conference calls like Starbucks and Nike, they are very hesitant about China, even to the point to where Starbucks is going to divest out of their Chinese business there because they're just having problems in the regions. Now, $14.5 billion is a first world problem for one quarter sales in Greater China, but this is something that if Apple can figure it out, it's not all up to them. There's geopolitics, there's economics, there's all different types of things going on in China that Apple has little control over. But if all that stuff starts to work in their direction and the momentum gets back into China, well, that's the other thing that could power this one up to even higher highs. Now, speaking of higher highs, no, we are not talking about the legal 420 that they sell on every corner here in California. We're talking about higher highs in Amazon stock. Start of the week at 227. This one up over 7.4%, including nearly 10% today as Amazon shares hitting a new all-time high at 244. I think the all-time high was 250 reached today. Now, this comes as the company announced their Q3 earnings yesterday after the bell. Record revenue for the quarter and $180 billion. Think about that, guys, that this company can grow rather modestly from a sales perspective. And in 4 or 5 years, they're doing $1 trillion in revenue. We're not talking about $1 trillion market cap. We're talking about $1 trillion in revenue. They grew in the most recent quarter by over 13%. This comes as the company projects that they are going to double their AWS capacity by 2027, and their Trainium, which is their custom silicon chips inside of many of these data centers, that is driving 150% quarterly revenue growth. The executives over at Amazon saying that that is already $1 billion business for them. This was all something that you could have telegraphed. There's an excellent website. You still have to connect the dots, but they aggregate all the news for you. Instead of going to ChatGPT, instead of going to the meme sites, instead of knowing what the 6-7 stuff means and all this stupid stuff that makes you no money and in fact waste your time and rots your brain, you should be on sites like Data Center Dynamics every single day. This should be a permanent tab on your browser, along with sites like Seeking Alpha, along with TradingView, and if you want to, Equity Empire as well. That is because in December of last year, the company announced these Ultra servers and the fact that they are going to develop large clusters of them, including continuing the development of Trainium 3, which should launch at the tail end of last year. Now, December was a long time ago. However, in June, They detailed this Project Rainier site and this compute cluster that said that they were going to have hundreds of thousands of Trainium 2 chips. And on top of that, Anthropic was going to be the lead customer there. This is why Amazon had north of 20% growth in AWS, and this is why the stock went up. This was all telegraphed in advance. If you connected the dots, once the press release was announced 2 days ago on the 29th, Amazon opens $11 billion linear data center project. This was old news. Now, you can't just come to data center dynamics and take what they have. The second step that you want to take is figure out where the site of this data center is, and then you can get satellite imagery and see the actual construction progress over a period of time. And this is exactly what I did. I wanted to make sure that this data center was on track. It was a big one. It's a gigantic one. In fact, it's one of the biggest in the world. It's one of the biggest ones Amazon has ever built. And if it came online, it probably meant billions and billions of dollars of revenue and growth for Amazon's US unit. And that is what we found out today. And that is why a month ago, we recommended Amazon. The technicals weren't great, but the fundamentals and all the research that I did for over a year on this single data center came true. And that is what we found out. If you want advice from me and you want to become financially free, if you want to do the research, if you want to make money in stocks, this is the type of effort that it takes. Every day I wake up at 4 or 5 in the morning, and every night I go to bed at 11 or 12 o'clock at night. And this is the type of stuff and the kind of dots I'm trying to connect. I believe you sitting there can do it too. And if you don't want to do it, you can pay me to do it, and I will gladly spoon feed you the picks. And I had several of our members reach out to me, our generous members, which are really the ones that are affording videos like this to be up commercial free, thanking me for this pick. But I can only thank them for giving me the opportunity to do all this research, because it's exactly what I love to do. Now, in terms of Amazon, the financials were like they were okay. They lead with this cash flow statement, and you can see over at Amazon, we talked about this with Meta, they got punished for the diminishing free cash flow. With Amazon, we've been trained for 25 years to not care about it. The company generated $35 billion of operating cash flow. They spent every last dime of it on property, plant, and equipment. They don't have a buyback. They're not paying a dividend. Portions of your portfolio can certainly look like this. Got to be a little careful when you're listening to CNBC. They bring on these guests where they can only look at free cash flow metrics, or they can only look at PE ratios. Yes, a portion of your portfolio can be invested like that, but understand that anybody on CNBC is managing money for multimillionaires who are more concerned about keeping their wealth and preserving their wealth than growing their wealth. If you want to grow your wealth, you want to look for companies like Amazon that are aggressively spending like this. This can be a portion of your portfolio, particularly a growth one. Now, when you came down here to the operating statement, it shows you also the fact that the operating income year over year, not great. In fact, it's slid sideways from 17.4, essentially flat despite the higher revenue growth. That is because you had massive cost increase really across the board. The company is likely also absorbing some of the tariffs that we're seeing on the retail side. On the North American retail side, one thing that disappointed me was we had an increasing operating income on the e-commerce business year over year for several quarters. That declined from 5.6 down to $4.8 billion. But you have to understand what Wall Street cares about right now. All they care about is US growth, and that accelerated back up north of 20%. And I will tell you, all of my other research points to the fact that that growth rate is sustainable for Amazon. In fact, they told you on the conference call they're going to unleash all this power in this data centers, and they have even more for the rest of the year, and they have more going into next year. And then on top of that, they have a bunch of their own custom silicon, which if it can come out on time, the profit margins on that will exceed some of the other hyperscalers, which rely on Nvidia chips, which a lot of the margins clearly goes to them. You had acceleration of growth over at AWS and still massive profits on a quarterly basis. Now, the good thing about Amazon is they still have a lot of cash balanced off by some debt, but it's very manageable based on the number of customers, the amount of revenue. Like we talked about, in a couple of years, this company will be doing north of $1 trillion. They'll get robots to replace employees. We didn't bring those press releases up, but there's a lot of that going on. Now, AWS accelerating to 20. Here's the important thing. This is sustainable, at least according to the research that I have, and all the data center projects that they have, the satellite images, everything is pointing to these things are going to open, and that is going to likely mean that the revenues over at AWS should continue to accelerate. The rest of the business is looking pretty darn good. Now, speaking of looking good, we've got Netflix. Start of the week at, we'll call it 1100, bounced around and then found some footing after a 10-for-1 stock split and some interesting industry news. Shares of Netflix climbed over 2.2% the finished week at 1120. This comes, like I said, as the company announced a 10-for-1 stock split. 10-for-1 stock split doesn't do anything for me. I don't really care. It does make the options premiums maybe a little bit cheaper, and it allows the employees, which have to buy in whole number of shares, maybe a little easier to acquire some stocks. The other thing I don't like is when Kathy Woods piles into a stock, but with all due respect, I love Kathy. I think she's a great marketer. I wouldn't invest in any of her ETFs, not because of her, but I listen to some of the analysis some of our employees have, and it's as shallow as what I hear in 7th and 8th grade classrooms. And so I wouldn't trust this woman with a dime of my money, but boy, she's a great marketer. And if she ever wants to come and market for Equity Empire, we'd probably make $1 billion. Now, here's the important part about Netflix is they're tapping an investment bank to explore a bid for Warner Brothers Discovery, which was spun out from, I believe, AT&T not that long ago. Warner Brothers Discovery is a $53 billion company with likely a bid to buy it outright, maybe pushing it into the 70s to $80 billion, depending on what piece of Warner Brothers Discovery you're trying to buy, whether it's the whole thing or a piece of that. That would be a massive acquisition for Netflix, which I believe off the top of my head is about a $500 billion company. This would be a transformative acquisition for Netflix. But I don't necessarily think just because Netflix is tapping an investment bank here and just because they're poking around Warner Brothers Discovery doesn't mean they'll actually go through it. They've done this in the past. It would also be malfeasance, which is a word that I don't think I said right, and I certainly can't spell it, but it would be terrible if the management over at Netflix didn't at least kick the tires here, because when you kick the tires on one of your number one competitors, you get to look at all the financials. You get to look at everything. They give you an inside look to the company. In fact, Netflix reportedly has been granted access to the data room, which contains the financial details to make a bid. You kick the tires, and if you're Warner Brothers Discovery, you have to let Netflix kick the tires because it's one of like 4 companies in the world that will likely buy you. And so they have to give Netflix access. So Netflix gets free information on the streaming and competitive aspects of a competitor, and they get it for free. Now, I am not convinced yet that one of these FAANG stocks will buy Warner Brothers Discovery, but I actually don't think it'll be Netflix. I would be surprised if Netflix does. I actually think Amazon and Apple are better suited to buy that, and I would be surprised if one of those two companies don't swoop in at some point and make a bid. Moving on to Nvidia, start of the week at 190, and we are popping on Nvidia as all these companies got on their conference calls and we say, we don't care about free cash flow. We are going to spend all of our money on the data center and Nvidia GPUs, as Jensen Huang was partying in South Korea and he saw his shares rise by over 6%, finished the week at $202 per share, and the $5 trillion market cap over at Nvidia has been breached. You are now trading at 44 times forward on Nvidia, so they better deliver, and by everything that we're seeing, they are. Now, one thing that would send the shares up meaningfully higher if you could open up the Chinese market, which during interviews this week, Jensen Huang said could potentially be worth $50 to $100 billion for Nvidia every single year in revenue and likely really high gross margins. President Trump said this week as he met with President Xi that there were no discussions on Nvidia Blackwell. That was not how China and these negotiations go. In the future, anytime there are negotiations between the United States and China, this is how it works. And it's more from a societal perspective of how Chinese government works. In the background, the Scott Bessents of the United States and the dignitaries from China, they go back and forth. That's where all the negotiations come. President Xi is not going to negotiate. He is going to come in at the end. He's going to have a photo op. They're going to take a picture. They're going to sign some documents. That's what he is for. I'm not saying that he doesn't do any work. I'm saying that's how Chinese get negotiations done. Now, Trump's obviously a little different. He'd like to get on a phone, talk to President Xi, maybe play some golf, but that's not how it works. And so Trump likely knows this at this point. And so, yeah, they didn't discuss anything this week because those discussions have already been had by the staff of the respected administrations. I believe right now, China is playing the long game when it comes to semiconductors. They know there are 2 generations behind Nvidia, but they don't care. They think that they can continue to invest in that area and then in 5 to 6 years be at parity with Nvidia or maybe ahead. It'll be Nvidia's job to continue to stay 2 generations, 3 generations, depending on how you look at it, ahead of China. If they keep doing that, then yeah, it will put China in the back seat. But in the short term, the country believes it can catch up on its own. Qualcomm, in an absolute absurd headline here, saying that it looks to take on Nvidia and AMD as it enters the AI accelerator market. I sent out a note to premium subscribers about this. You have to chuckle when you see headlines like this. If you don't chuckle and you don't understand what this headline means, you just need to do more research and become more knowledgeable about the hierarchy within the data center and the hierarchy within the semiconductor industry. And this is no due respect to Qualcomm, which is actually an open recommendation over at Equity Empire for premium subscribers. Now, we bought it a long time ago, and so I wouldn't buy it here at 181. And I actually believe that Qualcomm's product portfolio is vastly underrated and undervalued even at today's prices in the marketplace. But they are not taking on Nvidia. They are not taking on AMD. They're carving out a unique segment that is likely to emerge next year. And if this segment of semiconductors inside of the data center really takes off, which I believe it will solve many of the power constraints that we're seeing and also free up these GPUs that are very expensive to do other things like run training models and develop even more of them. This is an exciting development for Qualcomm. Intel has had a similar announcement over the past week or two. This inference or reasoning chips, this will be a much broader market at much lower margins, but at the high-end accelerator market, there's one king, and you know who he is. Company held its GTC DC conference this week. Not a lot was said. They did partner with some quantum computing companies in terms of trying to get their GPUs essentially paired up with that. If you want to invest in quantum, you obviously have to have the stomach that is much firmer than mine. I think the mega cap play that is probably through IBM. They're talking about AI factories, but also robotics and U.S. manufacturing, where Nvidia obviously has some computer chips, but also a lot of the software as well. That'll be very exciting once that industry takes off. Speaking of taking off, we move on to Google. Start of the week at 265 and ba-boom. Everybody's still watching YouTube. Everybody's still clicking on ads in Google search as Google shares climbed to, I believe, an all-time high, over 6% this week and closed at about $281 per share. This comes as the company announced their Q3 earnings, $102 billion in revenue. They crossed the $100 billion mark for the first time over at Google, and they've got a fourth quarter coming where it's going to go even higher. 16% growth, beat on the top and the bottom line, and these financials are a thing of beauty. YouTube ads. I should run ads on my videos, and I should start posting more videos because they are giving away the money. $8.9 billion or $9 billion of ad money last year, all the way up to $10.2 billion on your search. I mean, everything's humming right along. Here was the key thing, your Google Cloud on the revenue side, 11.4 all the way up to $15 billion. Look how profitable cloud is, $2 billion up to 3.6. Guys, whenever somebody gets on CNBC and is like, oh, I don't know about this spending on all this CapEx and data center, I don't know if it'll pay off. Here it is right here. Like, do these guys not open up the financials and look at it as clear as day? You don't even need to know anything above third grade math on this thing. They had $15 billion in revenue and they had $3.6 billion of operating income, which is like 50% higher than it was a year ago. Why wouldn't you keep investing in here? That's why you have smart people running these companies, and idiots often get on TV and try to analyze it. From a balance sheet perspective, it doesn't get any better than Google. I mean, they have $100 billion in cash. They got a bunch of property, plant, and equipment. They have very little long-term debt, although it's accelerated over the past year. No big deal, though. More than offsets it. I mean, this is the best balance sheet in big tech right now, outside of Nvidia. Nvidia's is probably even better. That's why they have the $5 trillion valuation. Now, from a cash flow perspective, this is what we were talking about with Meta. So with Meta, I'll refresh your memory here. Meta earned $30 billion of operating cash flow, and they spent 19. So the delta between here is only about $10 billion, and it's going to close even more because Meta signaled that they were going to invest even more. So they've only got a $10 billion gap here, and you got to pay a small dividend, maybe do some token buybacks as well so you don't dilute yourself on the stock-based compensation, which they are doing. Now, with Google, it's a little bit different. The delta is still wider because you had $48 billion of operating cash flow in the most recent quarter, and you only spent half of that on purchase of property, plant, and equipment. So you have even more headroom to continue to invest here. Now, the buybacks are going to slow down. That is going to piss some people off from an investment standpoint. I don't care. The dividends are still going to be there, but the buybacks over at Google are going to offset the stock-based compensation. So it's a true buyback, and they have plenty of room, plenty of free cash flow to continue to reinvest over at Google. And the questions about monetization, they obviously were slammed shut when the company announced their earnings. I believe that Meta will be able to do the same thing. You just got to give it some time. Now, here's something also as it relates to Amazon. I showed you there was a series of blog posts, and if you wanted to, do the extra step and do satellite imagery and stuff like that, you can see the progress of this stuff and make sure it's on track. Same thing with Google. They're going to partner with NextEra Energy to restart a shuttered Iowa nuclear plant. You can figure out where this nuclear plant is, bring up some satellite image, do a screenshot, come back 3 months later and see the progress. This is expected to be fully operational by Q1 of 2029. It's potential these things get reaccelerated under the Trump administration, as there's a lot of permitting acceleration, and certainly in the state of Iowa, they probably will be sympathetic to that as well. This would give Google a large amount of megawatts of power and obviously help fund a lot of their data center ambitions. Now, it's not all sunshines and roses. If you're trying to tune in to ESPN, Disney Channel, or ABC, Disney channels are going to go dark on YouTube TV over disputes because Disney is looking at these results and saying, Google, you can afford to either raise prices on your customers or pay us more money for the content. Now, moving on to Microsoft. Start of the week at 5:30. This one drifting lower by about 2%, but I think a lot of the good news was priced in with Microsoft. That's after the company announced their Q1 earnings, $78 billion, 20% or 19% growth, or actually it's 18% growth over at Microsoft in the most recent quarter. They also pledged, like the rest of these companies, to continue to boost CapEx, which Microsoft was conservative at the beginning of the year. They said, look, we're going to be in supply balance by the middle of this year. Then it turns out it's not. They're not even giving a projection on that. They also gave us guidance for the upcoming quarter between $79.5 billion up to $80.6 billion. They're coming in a little light because the expectations were actually higher than that at $80 billion. So some people were a little concerned about that, and that is why you didn't have massive increase in Microsoft shares. This comes as Azure continues to grow 40% year over year. Anytime people are like, oh, I don't know where this AI CapEx is going. Guys, it's going to a business growing at 40%. If your business was growing, I don't care what your business was, whether it's selling underwear or selling data centers, if it was growing 40% year over year on a quarterly basis, you would be rapidly investing in it. And that's what these companies have to do. Now, I mean, operationally, things look just fine over at Microsoft. Across the board, they're controlling costs relatively well, probably better than most of these companies. It comes from the fact that they have, I believe, one of the best CFOs of this big tech bunch here. She's absolutely fantastic. A little bit of a tightwad, but I say that respectively, and sometimes you need that in the CFO space. Now, from a cash flow perspective, this is what investors are digesting. They're saying, well, Microsoft has the operating cash flow to rapidly invest in property, plant, and equipment. In fact, they invested, I say just $19 billion. That's less than Google. That's like on par with Meta, and it's less than Amazon, but they generate $45 billion of operating cash flow. So less than 50% of it is going to CapEx. Now, they have a little bit higher dividend over at this company. They've been paying dividends for a longer period of time, and they've had that dividend growth. So that's a commitment that they make, and they're buying back the stock. In fact, they bought back more than they did the previous quarter. So the company is going to continue to be able to do that and control their property, plant, and equipment mix when it comes to build out. They were also one of the first ones to kind of expand into the area. And so they don't have as much catch up as maybe an Amazon has to do. Now, finally, moving on to Tesla, which usually has a lot of news, but this week, in comparison, not a lot, as Tesla started the week at 443, bounced around, and finished the week just up fractionally to 452. This comes as we have a key board vote. Anybody that's a shareholder of Tesla can actually pledge their vote inside of their broker app. Elon Musk $1 trillion compensation package. Now, I read through the compensation package. It seems pretty reasonable to me. I know the top end, $1 trillion seems like a lot, but my God, Tesla's going to have to reach, I think, an $8 or $9 trillion valuation for that compensation to fully vest. And so we are talking a stock that would like 5x, like darn near 10x for Elon to get his money. Yeah, if my shares of Tesla 10x, I'd be happy that Elon Musk got his bag too. Now, EU car sales rose 10%. However, Tesla continues to lose market share in the region. I keep saying that Tesla's got a little bit of a brand image problem. I think it's something that if you just ignore, it goes away a little bit over time. People forget that Chipotle got you sick, and so did McDonald's this time last year. People forget, and they go back and they forget about it. It takes about 12 to 18 months. When it comes to politics, the memory probably stretches out a little further, and the feelings that you get inside probably a little bit more visceral. I still think it would be wise to get the Teslas in the soccer players. I mean, soccer is big in the EU, and whatever's big there. Start sponsoring stuff and do that. I think that would help turn things around, but I'm not running Tesla, and probably for good reason. Now, moving over to the technical segments, we'll get to Meta in a second. That's an interesting one, but we'll start with the S&P 500. You might recall a couple of shows ago, I was like, oh my gosh, guys, we put up this big red candle. Now we're talking about an intermediate micro trend here. When you break through, you often do a back test, and then it is decision day. If I were to place a bet, and this is why, I don't make these types of bets, I would have bet we would have gotten rejected here and gone lower. But no, we defied gravity and we got sucked back all the way back into the trend, made a new higher high. This market is as resilient as it possibly get. Again, we're analyzing this in the micro trend, the longer term trend, the intermediate, everything is pointing up with this. And so when things point up, you buy the dip. Now, moving on to Meta, we broke down below the 200-day exponential moving average, this squiggly little blue line. We created a gigantic gap in the chart from 740 all the way down to 682. This gap in the chart will absolutely get sucked up and move Meta shares higher. Here's the other thing that I want to show you. Where is the demand for Meta shares now? Now that it's dropping, where do you step in and buy the dip? I believe you can probably step in now if you want, but a lot of people accumulated the shares up here at the 710 level. And so they're feeling a little uneasy about what Mark is doing. If you shrink this down a little bit more, it paints a similar story that a lot of the accumulation came at higher prices. All that adds up to overhead resistance, but support for the stock down here in this $600 range. If you believe that Meta, we're going to look back in 6 to 12 months and say, yeah, Meta is spending a lot, but it's not the metaverse. They have a core business. And what Mark Zuckerberg said on the conference call, he says, look, we continue to have this pattern where we're building this infrastructure to run AI ads and AI algorithms and suggestion models and all this type of stuff and chatbots on the different sites. And we have to keep coming back and building even more of this. This investment is in the core business. The metaverse was not a core business. It was a side quest, which at the time I said Mark should have taken money out of his own pocket, started a separate company, very similar to what Elon Musk does and Jeff Bezos and all these rich guys. They start a second company and they fund it with their own money. Instead, Mark decided to fund his side quest with Meta shareholder money, and he got punished for it. I think he's being unfairly punished here because this is not a side quest. AI is very important to their ad business. AI is very important to their user base. I believe when we look back a year from now, the company is going to be able to launch numerous products to their billions of users, and the users are going to use them, and it's going to generate revenue and stickiness on the apps and create a competitive moat around the business. You just got to give it some time. Now, moving on to Apple. Looks great technically. You just blasted off to a new higher high. You are at the top of the range with Apple. If you like taking profits on your stock, and anytime I mention the word profit, sometimes people light me up in the comments, but I'm not as rich as all of you, considering I'm not running ads on this video. I am a poor soul, so I do have to take profits on a portion of my portfolio every once in a while, and these are the areas that you can do that with Apple. Now, Amazon, big gap up, and this is super exciting technically. Okay, this was like a multi-tested high here. This high at 237. You got to close above it, and we did. Now, we created a gap. Wouldn't surprise me if Amazon comes back here and it's 238. If you want to set up kind of a shorter-term trade, there's a big gap here. I would have a stop loss underneath that gap at 230. So if you buy it at 238, you're risking 7 to the downside to have your chart start looking like Nvidia and Microsoft. And if you look at those charts, yeah, you had once you broke to the highs, there's this momentum type thing that happens where there's just a lack of sellers, and then retail piles in at the top. And that's why you have these pushes. There's no natural sellers at these prices. And then you have retail come and chase it at the end. And so you have this push and this pop all the way up. Couple things could materialize with Amazon, but what would be the most interesting is if you have a back test of these previous highs, that would be your time to go, go, go. Now, speaking of go, 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 we've been in this multi-year uptrend with Netflix. Now, we very temporarily kind of peeked our way out the bottom of the channel. No big deal. You go ahead and keep that channel line on because you often come back and do a back test. That's basically what we did today. This 200-day moving average is holding for Netflix, but the micro trend is not looking good. Low, 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 lower, low. That is a downtrend. On the highs, you made a high, lower high, lower high. You probably confirmed a new lower high. But if you look at the history of the stock chart, anytime you've come and touched the bottom of the channel, the same thing, the same pattern plays out. So it doesn't necessarily mean you're going to continue to crap out the bottom. You'll want some kind of stop loss on Netflix, but right now things look pretty good technically. You'd like to see this one hold this. It's got to hold this level, obviously, and you'd like to come in here and close this gap. This has a large gap between $1,150 up to about $1,200. You close that gap and it's off to the races again with Netflix. Speaking of off to the races, very similar to the Amazon chart, we had resistance with Nvidia at 184 for the longest time. We peaked up, came back, consolidated, and now we're having our blast off moment. We're creating a beautiful series of higher highs and higher lows. Again, this is the shorter term. This is looking like the new trend. Maybe we are not on this parabolic hockey stick uptrend. What often happens when the business transforms and the business is sustainable, don't apply what I say here to small cap stocks. That's a whole different story. But when we're talking mega cap and we're talking profits and cash flow and buybacks, if you have this hockey stick type move, what will happen is you'll eventually break through that hockey stick and then start a shallower uptrend. That looks like to be the case with Nvidia. Now, we are on Nvidia watch as they report earnings in 19 days. That'll be very exciting. Google, looking absolutely sensational. This one's gone hockey stick, and this is what you're hoping for with Meta. You had your worry. Everybody's going to stop searching. ChatGPT is going to take off the world. And then finally, you had the realization that that's not going to be the case, and you had this parabolic V-shaped recovery. I think when we look back in 6 to 12 months, Meta will make a similar type of move. Google has already completed that move. You're looking for pullbacks. The first one is back to 260. Now, Microsoft has already broken out of its previous highs. Its previous highs were in this range in the 440s. Once you break out, it's off to the races. You went from 460 all the way up to 560 on this one. Pulled back to a logical area, made a double top, and now here you are. Microsoft's just chilling up in this zone. Its financials and its outlook supports all of that. Tesla is where Amazon was just a couple of weeks ago. Look at the charts of Amazon. Look at the chart of Tesla. They look exactly the same. You are setting up at these highs. The stock is trying to decide if it wants to go higher or lower. Tesla has a lot of things, not from a financial and business standpoint, at least from an immediate revenue standpoint, but they have a lot of hypey things around the Optimus robot and robotaxi in which they can generate a lot of hype. And this one can push up into all-time highs north of 550, maybe even as high as 580. Those are the areas where if you like to take profits on Tesla, you can. Don't come crying back that you didn't, because it is also likely that this stock comes all the way back down and retests the bottom of the channel, because unlike a lot of these stocks, this one is very, very volatile to say the least. This was a $150 stock in April of last year. We're sitting here at $450. Don't be surprised if you're retesting $300 on this one at a later date. Folks, that was the FAANG Stock Recap Show for Friday, October 31st. I'd like to wish you all a happy Halloween. I'm going to edit this video and go trick-or-treating with my boys, which are still at the age where they're dressing up and they like to go get candy. It's a very exciting age, which I'm sure most of you either have memories of or you're in the midst of. If you don't have children, my advice to you is find some woman that will bear your children. Or if you're a young lady watching, find yourself a young man who also watches the FAANG Stock Recap Show. Maybe we can pair some of you guys up and have some children and get married. It's one of the biggest, not one of, it's been the biggest blessing of my life. The second biggest blessing of my life is the fact that I get to come here every week and share this information with all of you. And I mean that sincerely. This is something I look forward to every single week. And the fact that I turn off the ads on a video that would probably do relatively well just goes to show you I am doing this to hopefully inspire you, hopefully give you some information. And more importantly, I hope these videos make you some money in the long run. Thank you to all the subscribers over at Equity Empire. We'll continue to try to do our best. I don't try to cherry pick the best things and put them up here. Amazon was my only recommendation last month. If you're interested in subscribing, there's always links down below. But in the meantime, I'll continue to try to produce as much free content here as possible. And there's always a lot more coming. Thanks for everybody that's tuned in. Thanks especially to everybody that has signed up over at Equity Empire. Your belief and your support means so much to me, and I think about you, I pray for you, and I appreciate you. Have a great rest of your weekend. Be safe this weekend. If you go out on Halloween, also be very, very safe tonight. You want to come home, and you want to be back next week for Friday's show. Thanks for tuning in. We'll see you again soon. Good luck with your investments.